the Professional Development Chair. Today is going to be very exciting because we're learning about filing business and personal taxes. We were lucky enough, I'm not sure, but we had an extension given to us from our federal and state tax offices. So we're going to talk a little bit about that. But first, I would like to thank our sponsors. So today we have our presenting sponsor is Boulder Medical Center. We'll talk a little bit to them in a minute. Gold sponsors, Blue Federal Credit Union, and silver sponsors, Flatirons Bank. Thank you so much to them. That's how we get to do these events. And especially when we get back in person soon, they really help us put those events together as well. So like I said, I'm going to have our presenting sponsor, Boulder Medical Center, talk to us a little bit. They have Summer Mullen here. So if you wanted to say a couple words, just feel free.
Thank you, Gabby. My name is Summer, and I am a recent graduate from the University of Colorado Boulder. I graduated last spring, so kind of in the midst of this pandemic, and I really am excited to get to know a bunch of new people living in the Boulder area. It's been so hard to reach new people, especially with right now. So I am super happy to be a part of this. And a little bit about myself. I've been working at Boulder Medical Center in healthcare administration for about a year now. And we have some great new physicians who just started in our urgent care. So if you are finding yourself in need of a quick urgent care visit, unfortunately, we do have some of the quickest wait times in Boulder right now. So feel free to stop by our urgent care. And with the increases in vaccines, which is fantastic, if I do say so myself, we are going to start seeing some things open up, and that might introduce some new sicknesses in the area outside of COVID. So if you are looking to get in for a primary care visit, now would be a great time to do so if you're comfortable with coming into an office. We have some great internal medicine, family medicine, and pediatricians who have very flexible and open schedules. So happy to put that out there and set something up. If you are looking for a new primary care doctor, feel free to send me a chat message and I'd be happy to set you up with one of our docs. Apart from that, we are super excited to be the presenting sponsor for BYP. We're going to have some great physicians coming to these meetings to pretty much give free medical advice and tell them a little bit about what they do and answer any questions that you have. So if you want any specific topics, say you want to hear about like non-invasive spine treatments or how to better deal and prepare for seasonal allergies, definitely let me know and I can coordinate and make these things happen so that these talks are relevant to what you want to hear. So,
oops, you muted yourself.
Oh, sorry about that. Well, here's my contact information if anybody wants to get a hold of me. That's my personal email and cell phone. Feel free to send me a text, email, or give me a call. And I hope to hear from you, even if it's just a hi, welcome to the area. All right.
Thanks,
well,
Summer.
you.
That's great. Awesome. And we're so excited to have some physicians coming in too. All right. I also really like to take a moment just to call out all of the Boulder Chamber ambassadors. I think a few of them are on the call with us today. As a BYP board member, I'm also considered an ambassador as well. And it's always so much fun. And it's great to help provide that friendly face at these events and help to answer questions that you might have about the BYP, about the chamber, or just about the community in general. It's really great. So if you did want to reach out to any of us, you can share your info in the chat, or you can just email us at events@boulderchamber.com. I'm happy to help you connect with whatever you need. And then just a little bit of Zoom etiquette. I know most of you are probably very, very overly familiar with Zoom at this point, but just in case, as a reminder, please keep yourself muted while people are presenting or speaking so we can hear everybody else, especially if you're like me and you have dogs and other things making noise. And you can also kind of change the mode of your screen if you want to see different things. You can see speaker mode if you just want to really focus in on who's talking. You can do the gallery mode if you want to see everybody else. Kind of up to you. The option to do that is at the top right of your screen. At the end of this, we are going to have some opportunities to ask questions, and you can do that by using the reactions button at the bottom of your screen with a little hand. You can raise your hand so we can make sure to call on you. Or if you wanted to just type it in the chat, you can click the chat button. You can either ask me directly and I will moderate your questions, or you can just ask it to the whole group so we can all see it. Up to you. All right, so now we're going to move on to what you're all here for today, our panel presentation. So we're going to hear from tax professionals who will cover all of the ins and outs of filing taxes for your business or personal accounts. So like I mentioned before, the deadline's been extended until May 17th this year. So you still have a little bit of time to get your filings in. With the pandemic, some changes have taken place, including new credits and payments, and they're going to cover that and so much more. So after they present, we'll have that time for Q&A I just mentioned. Save all your questions till then if you can. And it's also, like I mentioned too, being recorded, so we can share the recording with you later if you wanted to go back and review some things. So today we have Jeremy Wilson, CPA, with he's a partner at Plante Moran, and Mark Lumsden, also CPA, a partner at BDO, the Boulder Office. So I'll send it over your way and let you go ahead.
Thanks. I don't know, Gabby, do you want me to start? Mark, right?
I was gonna say, that was the one thing we never figured out. Who's
we didn't flip a coin.
Jeremy, I've decided you're going first because I said your name first.
Okay, perfect. And it looks like I can't share my screen yet, Gabby. The button's there, but it said the host has disabled screen sharing.
Oh, well, I guess I should give you some power then. Let's see if I can do that.
Yeah, I think you can try now.
Okay, perfect, got it. Thank you. Let's see.
There we go, we got it.
Okay, it's gonna pop up on the wrong screen. It does it every time. There we go. All right, well, thanks for the introduction. My name is Jeremy Wilson. I'm a partner with Plante Moran here in Boulder. Our offices are still basically closed, but trying to navigate what that looks like over the course of the next 4 or 5 months, I guess. I joined the firm in 2007. We were still EKS&H at that time. I don't know, maybe that name is more familiar than Plante Moran, and combined with Plante Moran in October of 2018. Just a couple high-level facts about our firm. We're a Michigan-based firm, founded in 1924, and the combination with EKS&H back in 18 really expanded the westward focus for the firm and brought a tremendous amount of resources out here. So really happy to be part of the team. Serve mostly middle market companies, which is nice. That was EKS&H's sweet spot also. So a real nice fit from a client perspective, serve clients in a bunch of industries. My main focus is commercial real estate, professional services, and manufacturing, but I've been doing this for a long time, so I have experience in a wide variety of industries, private equity, a lot of merger and acquisition activity, and individual tax as well. So happy to answer any questions that come up. My focus really is on the business side today, and just really wanted to emphasize that from a tax perspective, the theme since really about December of 2017 has been change. And it seems like there's going to be more coming right around the corner as the Biden administration kind of, gains more control and starts to influence and bring forward their tax plans. Mark might spend some time on that because a lot of it has been individual focused, but just know that there's been a lot of change and it seems like there's more on the horizon. I'm going to highlight some of the programs that are available to small businesses right now. And if any of these, if you have questions about any of them, you can put them in the chat or just wait until we're done and do the live Q&A. But there's a lot of valuable stuff out there, so please don't hesitate to ask questions if you have them. Just wanted to set the stage a little bit. Like I said, we've been dealing with change in tax law really since December of 2017, and a lot of the times our answers are I don't know, or it depends, or I don't know yet. And while that might sound bad and it is somewhat unfortunate, sometimes that's the best we have. 2020 was really intense for a lot of reasons, and tax law obviously is not as important as many of those reasons, but there was a significant amount of change last year and stuff that happened really rapidly, a lot of uncertainty throughout the year. Staying close to our clients has always been really part of our corporate culture, and I think the last 13 or 14 months really have allowed us to flex that muscle maybe more than we ever have. So this is just a little bit of highlight of what tax legislation that we've had since really December of 17. It started out with the Tax Cuts and Jobs Act. That was gave us all kind of the most overarching change in tax law that we had seen probably since 1986. You may not have recognized that, but it was definitely there. We all kind of felt, so if you kind of think about this from a tax reporting standpoint, December 17 is when that act was passed. Most of the changes went into effect on January 1st of 2018. And so, it didn't really impact your tax return until 2018. So it was really in the winter of 2019 when we were first starting to put all these changes into practice. And so 18 was kind of tough from a tax perspective. 19 was kind of hard from a tax perspective. By the end of 19, in early 2020, I think a lot of us in the tax community thought that 2020 was going to finally have some normalcy because we had gone through a year or two of understanding what the Tax Cuts and Jobs Act did. Of course, that was not the case. And here we are. And then these, starting with the Secure Act in January and really going all the way down through the American Rescue Plan Act that just was passed a couple months ago. We've had all this stuff in between. So a ton of stuff. And of course, all related to the COVID pandemic. And then here's the legislation that's coming up on the horizon. The American Families Plan is mostly individual focused. I'm not going to spend too much time on that. But the revenue raised is earmarked for things like education, childcare, paid leave programs. And then the American Jobs Plan and the Made in America Tax Plan are more infrastructures bills. So, highways, bridges, that kind of thing. A lot of energy efficient and, clean electric cars, things of that nature. And most of the revenue generation to support those plans is in the form of corporate and international tax changes. So we've had a ton to deal with and more on the horizon here for us, it would seem. So what do we do now? There are a few things that are in play right now that are important to think about from a business standpoint. Hopefully some of these are already familiar, but wanted to go through them in just a little bit of detail one by one, just to kind of raise some awareness. So the first one on the list, the employee retention credit, really came about with the CARES Act last year. It's been expanded. It's extended through December 31st, 2021. And we have just seen a ton of activity in our firm with this program. It is a refundable payroll tax credit claimed on payroll tax filings. It's not necessarily an income tax piece of legislation, but something that is extremely valuable to small businesses and something to take a look at. The maximum amount of credit really for 2021, if you fit the right fact pattern, would be $28,000 per employee. And so from a cash flow standpoint, this has been hugely beneficial to our client base. We're dealing with these calculations day in, day out. It's been really kind of fascinating to see how much cash is being freed up as a result of this program. In 2020, the credit was limited to $5,000 per employee. The change with the Consolidated Appropriations Act, that's the CAA, expanded that credit, expanded the benefit to be $7,000 or 70% of the first $10,000 per employee per quarter. So it's pretty significant change, and one that's, again, providing a great deal of benefit. Eligibility for that credit kind of varies year to year, but there's some highlights. You have to look at employee headcount in 2019. You have to see if there was a government shutdown order for your business, and then also a decline in gross receipts. Oftentimes that's where we're locking in qualification for our client base, is a decline in gross receipts from 19 to 2021. So not 2020 is kind of skipped in terms of that gross receipts test for generating credits in 2021. Any cash that you get as a result of this program is fully taxable. So just keep that in mind if you do participate in this program. And let's say you think you're going to get $250,000 back. Well, it's going to be less than that, most likely, because it is fully taxable, but still a hugely popular program. We could spend this entire time talking about the employee retention credit. There's a ton of ins and outs, tons of different rules if you are a big group of entities rather than just one entity, who's getting paid, what qualifies as wages for purposes of the credit. But really, I just wanted to raise awareness and talk about it at high level because we don't have time to go through everything. The payroll protection program, I'm sure, oops, I have a typo, that's always good. The payroll protection program has been all over the news. I'm sure everyone has heard just a little bit about that. Still in play. You can still get a first and a second draw if you need one. It's open until May 31st. This was one where we had a ton of uncertainty in 2020 up until maybe late November, early December. There were just some things that we didn't know from a tax perspective what would happen with these loans, but we do know a few things now. All expenses that you used PPP money for are fully deductible for tax purposes, so that's really good. I was in the camp that thought that was never going to happen, and told just about every one of my clients that I felt that way. Took a long break in November and December and had to come back and call everybody and tell them I was just flat out wrong, which, I was happy to be wrong on that side of the coin because it was hugely beneficial to everyone. When the PPP loans are forgiven, which I think is pretty much everybody's ultimate goal if they've secured a loan, that forgiveness is not taxable when it happens. So that's really good. That's one thing that we know now. If you are an owner in a flow-through entity, so a partnership or an S corporation, you do get a basis bump when forgiveness happens, which is really good. And we found out some news, I don't know if it was last week or the week before, about fiscal year entities and just when they can time the deductions that were funded with PPP dollars. So we know a lot about what we need to know with the payroll protection program. There's just one kind of, at least one gray area, one big gray area from my perspective, which is the timing of the forgiveness, the income, tax exempt income that arises as a result of forgiveness. There's some fact patterns that would lead you to want to accelerate that forgiveness perhaps sooner than when the SBA has actually signed off on your forgiveness application. Somewhat nebulous, but it is out there if it applies to anybody. Give that some thought, or you can ask me a question here at the end. Happy to talk through that. The credit for paid leave just got extended through the end of the third quarter of this year. That was originally given to us by the Family First Coronavirus Response Act, extended with the Consolidated Appropriations Act, and then extended again with the American Rescue Plan Act. So available through September 30th of this year. Again, similar to the employee retention credit, it is a payroll tax credit that you have to claim on your quarterly federal tax return. There are some limits to the amount of credit you can take. For paid sick leave right now, I think this number is the same as it was last year, but it's $511 a day for 10 days. So if you're paying an employee while they are out for COVID related reasons, whether they're sick or they're caring for a family member that's sick, or now the ARPA extended this to people that are getting their vaccine. If you're paying someone while they're not working, and they're not working because of COVID related reasons, you can claim a credit and generate some refunds with the filing of your quarterly employment tax returns. Has to be COVID related. It used to be mandatory. It's no longer mandatory, but there's the FFCRA set forth some qualifications. You kind of still have to meet those qualifications, but it's not a mandatory thing anymore that employers have to pay while people are out for COVID related reasons. So that's out there. It's a great benefit. The Restaurant Revitalization Fund, it's in the news. I'm not necessarily active in this industry. I don't know if it applies to anybody on the call today. I just wanted to mention it quickly. It is an SBA administered program. The SBA has been extremely busy this year with the Payroll Protection Program and now the Restaurant Revitalization Fund. There's been $28.6 billion appropriated for this, and it's a first come, first serve. So I actually was looking at the SBA portal last night. I couldn't get very far because I don't have a restaurant and didn't want to go through all those steps to actually get into the portal, but it's there if you want to submit an application. There's a pretty good 22-page PDF on the SBA's website that gives you kind of all the ins and outs on how to qualify. So I don't want to spend a ton of time on that. Like I said, I don't know how applicable it is, but just wanted to mention it since it's in the news and it is out there. A couple things on the retention credit and the payroll protection program and payroll tax credits. The credit generating programs, ERC and the payroll tax credits, it's all really a self-reporting mechanism. I mean, you're just doing this on your own basically, or with coordination from your payroll company in order to generate that cash, which is really fascinating. You're always, when you sign a tax return, you're signing it under penalties of perjury. So one thing to keep in mind, and I don't want my message here to be misconstrued, but it's very interesting to me just how much little substantiation is required for calculating these things. And one of the earmarked amounts in Biden's plan is ramping up enforcement with the IRS. I can't remember the number, but a pretty significant dollar amount is going to be allocated to the IRS so it can increase its enforcement. So just be cognizant of that if you want to go for some of these credits. Get somebody to help you do the math to calculate them. And then if you want to go for employee retention credit, a payroll protection program loan and payroll tax credits, if you're going for all three, just make sure you're running some numbers. Typically, you can't use the same salary amounts or wage amounts to qualify for all three programs. And you just need to make sure you're running the math to make sure you're maximizing the benefit from all three. I'm sorry, I'm just checking my stopwatch here. Okay, a couple more minutes. One thing that sounds like it's going to change is the corporate tax rate itself. So the Tax Cuts and Jobs Act, that's the TCJA, that set the corporate tax rate at a flat 21%. So if you are a C corporation, tax paying corporation, not a flow through entity, your federal tax rate is 21%. Sounds like the Made in America plan wants to juice that back up to 28%. And I'm sure Mark remembers this because it wasn't that long ago, but when the TCJA came out, we were spending a lot of time talking about choice of entity. Does it make sense to be a flow-through entity anymore? Or does it make sense to convert to a C corporation since the tax rate is so low? I'm kind of anticipating that we're going to be back in that mode, as time goes on in 2021, if these bills start to pass, and I think one thing that we have now that we didn't necessarily have at the tail end of 2017 is just some runway to make really knowledgeable decisions. So wanted to throw that out there because I think it's relevant as we move through the rest of 2021. So that is it on my side in terms of presentation. I'll turn it over to Mark, and please just feel free to put a question in the chat or just speak up during the Q&A. Happy to answer any questions.
Thanks, Jeremy. I'm not as prepared as Jeremy. I have my notes on a sticky note as opposed to a full slide deck. So well done, Jeremy, on that. Figured I'd just kind of talk through some of the items, but I guess give a brief introduction. So my name is Mark Lumsden. I'm in the Boulder office of BDO, similar to Jeremy, where he started with EKS&H and moved to Plante Moran. We actually just joined with BDO last August. We were previously a firm called ACM. I totally forgot this morning that I was going to be on camera and wore my ACM shirt. Still a good shirt. So luckily, not a lot of people in the office, so I'm not getting too much trouble for that. But yes, I joined ACM back in 2012 and have been here ever since. And yeah, work with a lot of small businesses and their owners. So I'm going to be talking a little bit about the individual taxation, some changes that happened recently, some changes that happened not as recently, but I'm still getting a lot of questions about that I figured might be good to know about. And then depending on what the clock says, I can talk about the rumor mill and some potential changes coming up as well. So yeah, some of these, I mean, again, I don't know how many people do own a business or are self-employed or are employees, professionals within a firm and they're employed, but this will be kind of trying to touch on everybody as best as I can without it being specific and leaving a bunch of people in the dark or out in the cold, I guess. But yeah, so let's start with some of the more recent changes that are somewhat hot off the presses. So stimulus payments is a big topic. At this point, there have been 3 rounds of stimulus payments, 2 that happened in 2020 and 1 that happened earlier this year for varying dollar amounts, because why would we keep them the same amounts? Whatever Congress could manage to squeeze through, I guess, is what was available. So hopefully the answer is that everybody on the call received their full payment on time for all 3. Nothing got lost in the mail or anything. You weren't dependents in an earlier year. For any of you that literally just graduated from college, you might have that one last year where you were a dependent on your parents' tax return and didn't qualify, or your income was too high. That could be a possibility as well, and therefore didn't qualify. Well, so for any of those payments that you didn't receive, you do get sort of a second chance to receive that money, and that is through a credit on your tax return. So instead of just getting a check or getting a deposit or a debit card, a deposit in your bank account or a debit card in the mail, it could be that you basically recalculate the amount of the credit based on your current circumstances for your 2020 filing year, as you're filing your 2020 tax return. And yeah, if it turns out, I should have, that first payment, it was $1,200. The maximum was $1,200 per person. I only got $1,050 for whatever reason, but that now this year, based on my 2020 numbers, I qualify for the full $1,200. You can get that back in the form of a tax credit. So definitely as you're doing that, that's often overlooked. So keep that in mind. Go back and double check your records and make sure that you got the payments and make sure that they were the full amounts. Even if you don't know what the full amounts are, if you look at your records and see a deposit for some random, $512.16, you probably got a reduced amount. And again, it's worth just double checking and seeing if you qualify for the higher amount. The good news is that if it goes the other way around and previously you qualified for the higher amount, got the check, and now you redo the math and find out for 2020 you don't qualify for the higher amount, you still get to keep it. You don't have to pay it back or anything. So yeah, once the money is yours, and assuming you didn't do anything fraudulently or anything like that, once the money hits your account, it's yours to keep. So yeah, that's the current situation on those stimulus payments. Again, 2020 is only right now the returns that are being filed now for last year, 2020, really only deals with those first two payments. The one that was in March-ish, shortly after, or I guess it would have been April, shortly after the pandemic started, and then the one later in the year. For the one that happened earlier in 2021, the same thing will be true, but that will be collected on or reported on your 2021 tax return, which is the return that you'll be preparing, a year from now. In either case, one common misconception that I'm getting a lot of questions on is whether that is income to you. And the answer is no. So not only do you get to keep the money and potentially get more money, but that then doesn't turn around and get taxed, and you have to turn around and pay some of that back through paying more tax. That's just free money to you. It's actually considered an advance payment of a tax credit. So yeah, you don't have to worry about reporting those payments on your tax returns. Jeremy talked briefly about PPP loans. I'll just mention, a lot of businesses took advantage of that. It is and was available to self-employed people as well. So even if you don't have an S corporation or a C corporation, if you're just doing freelance work or just work as a contractor, you very well could qualify. It depends on your circumstances, so I won't say that everybody will qualify, but it's worth looking into if you didn't get a PPP loan. And again, that deadline is coming up pretty quick, the end of this month, so you want to get on that quick if you haven't already. And again, Jeremy mentioned this, but the PPP forgiveness, so as long as you spend the money on the certain things, mostly payroll, AKA the payroll protection program, then it's just forgiven. You still have to apply for forgiveness and sort of report and show that you spent the money the way you were supposed to. But you get a letter saying, okay, this was a loan, but now we're saying you don't have to pay it back. So it kind of converts into a grant almost. It's just free money. Not to get into too much detail, but yeah, Jeremy, while you were taking those 2 months off at the end of the year, I was having a lot of conversations, very uncomfortable conversations with clients, because what happened was when the program first came about, they put in the language of the law that this is intended to not be taxable income to the recipient. And the IRS, and just to clarify, Congress passes the tax laws. Like Congress actually puts together the tax code, and the IRS is in charge of implementing it or collecting on it and interpreting it. So the IRS looked at that law and said, okay, yeah, that's cool. We won't expect you to include your income from those PPP forgiven loans in your income. However, that's tax exempt income, and there's a separate law that's been around forever, had nothing to do with PPP loans, that says the money you spend or the expenses you incur related to tax exempt income are non-deductible. So we're going to say that the money you spent out of that forgiveness, the expenses that you spent them on are not deductible, which essentially makes it taxable. It's just took a roundabout way of getting there. And so we kind of crossed the end of the year, or got close. I'm trying to remember exactly when that problem was fixed, but yeah, I mean, I think everybody kind of thought that it was going to get fixed, and that they were going to come back and pass another law and say, no, not only do you not have to pick it up as income, but it's also all of your expenses are deductible. But yeah, I mean, that's the life of a CPA, is there's a lot of, we think this is going to happen, but we have to plan as if it's not. And so, yeah, a lot of year-end tax planning that I did for some of my clients, where they just wanted an idea of what their tax bill was going to be. We kind of had to do two different versions. It was, you know, well, if they pass the law, it's this, and if they don't pass it, it's that. And in some cases, I mean, some of my, you know, not as small clients where they got a couple $1 million of PPP loans, that could have several $100,000 of tax effect, you know? So yeah, either you're going to get a $100,000 refund or you're going to owe $300,000. So I hope that that's some good planning for you. Go do something with that information and let me know what you did. Well, they finally did end up passing that law, and now not only can you deduct the expenses, but you don't have to pick up the income either. And again, that applies to businesses that are, you know, set up as a separate entity, like as an S corp, a C corp, or a partnership. But it also applies to self-employed people that got PPP loans through their self-employed activity. Another big change that came recently is a one-time change to the child credit. So previously, that, you know, for as far back as I can remember, at least, there's always been a credit for having children, and the recent rules before COVID made that tax credit $2,000 per child. And of course, you know, it's not as cut and dry as that. There are some limitations, and there are some phase outs once you hit certain income levels and things like that. But I'm not gonna talk about that in my little 20 minutes. So assuming you qualify for the full $2,000, there is a one-time bump up where it's actually bumped up to $3,000 per child. And if you have children under 6 years old, it goes up to $3,600. Yeah, under 6. I always get that mixed up. Is it 6 and under or under 6? It's under 6. So you get, you know, an extra $1,600 tax credit under this one-time change that you wouldn't have got under the previous rules. You would have been limited to that $2,000. So again, something to be on the lookout for and be aware of. Another big change that came recently, I don't know how much this affects everybody on the call. Boulder, luckily, at least Boulder professionals have not been hit as hard by some of the economic downturn that came about with COVID as some other industries and areas of the country, it seems. But if there is anybody on the call who collected unemployment this past year, the general rule is that unemployment is income. You know, that is, even though it's a payment from the government, unlike stimulus payments, which are not income, unemployment compensation is compensation. It's income. So sort of after the fact, after the year had already ended, there was a retroactive rule passed that said, you know, just because this was an unprecedented, you know, a big problem, the first $10,200 of unemployment compensation will be tax-free for the 2020 tax year. So if any of you did receive a unemployment last year, 2020, and you received that 1099 form from the government showing what your unemployment compensation is, again, there are some phase outs if your income is over a certain amount. But if you're at, you know, I think the phase out starts at $150,000. So if you're under that level, you know, you're most likely going to qualify for that $10,200 exemption from that being included in your income. Interestingly enough, Colorado is very, we're generally known as being a very easygoing state when it comes to income taxes. We largely piggyback off of federal and not do like some states and just sort of create our own separate tax code, rewrite the whole thing ourselves. So in general, if it's deductible for federal, it's also deductible for Colorado. If it's taxable for federal, it's also taxable for Colorado. There are some exceptions to that, but in general, that's the rule. But for this item, they did not, they sort of what we call in the accounting world decoupled from the federal rule. And so, yeah, if you did collect unemployment and you do qualify for that $10,200 exemption, you still have to pay tax on that at the state level. Colorado did not go along with that. So those are the big changes, the big 4 changes for individual taxation that I wanted to bring up that, again, are really recent, within the past, since COVID, basically. It looks like I have a little bit more time, so I'll just kind of talk about some things that are a little recent, but not especially, really recent, not since COVID. So one thing that, again, I get a lot of questions about that is often overlooked or misunderstood, and people think they don't qualify, is a special deduction that came about with the tax cuts from 2017. And that's called the 199A deduction, 199A being the code section that it applies to. But also it goes by qualified business income deduction, and a few other names. But basically, if you're self-employed or if you have a business like an S Corp or a partnership that where you have income that is showing up on your personal tax return from a business, not just from a W-2, but actually running a business or owning a business, I guess. A big chunk of that could essentially be tax-free. Again, it's a somewhat complicated formula based on your income and based on the industry that this business is in. But the super short version is up to 20% of that income from that business could be essentially tax exempt. It could be reduced out of your taxable income, and that basically makes it so that you don't have to pay tax on it. The whole idea there was, again, as Jeremy was saying, in that same law or in those same time frame when all those tax cuts were passed, they slashed the rates for C Corps, for corporate taxes, all the way down from the top rate being 35% down to 21%. Now it's a flat tax of 21% for the most part. So in an effort to kind of even things out for individuals that own businesses and are being taxed individually instead of through a corporation, that's what this was intended to do, to kind of give you lower taxes for being a business owner, and not necessarily making it so that you had to switch to being a C corporation in order to do that. So if you are self-employed and you have no idea what I'm talking about, you've never heard of this, or you've been told that you don't qualify, or you've just assumed that you don't qualify because you don't own a corporation and you're just running it through as a sole proprietorship or something like that, it's definitely worth looking into, because it can save quite a bit, depending on your income level and things. And again, it's more complicated than I put it, but I think I gave a good enough explanation that you have a general understanding and at least know if it's worth Googling after this call. I will say, so, standard deduction versus itemizing your deductions is another thing that I hear a lot about. And so, again, I don't know how familiar with everybody is on the call with how all of this works, so I'll keep it very high level. But basically, you hear about these things, oh, this is tax deductible, or, oh, you can, use this against your taxes. What happens is you basically get a choice when you're filling out your tax return every year. I'm sorry, my computer is chiming at me for messages. I'm going to put myself on Do Not Disturb, which I thought I already did. So yeah, you get a choice between what's called the standard deduction and what's called itemizing your deductions. Itemizing your deductions is just that. It's a list of things that are deductible, that you can just basically add up what you incurred during the year and then take those against your income and reduce your income so you don't pay as much tax. These days, in general, the big 3 items are mortgage interest. So if you own your home and you pay a mortgage, you can deduct the interest on that mortgage. Charitable gifts. So if you're donating money to a qualified organization, whether it be through cash, through non-cash, so those bags of clothes you drop off at Goodwill, those qualify. And also, non-traditional donations like donations of stock or real estate or things like that. Those are itemized deductions. And then taxes paid. So if state and local taxes. So if you have taxes, state income taxes taken out of your paychecks, or payments that you make, those would qualify. Real estate taxes, if you own your home, those would qualify. So if you add all those up, you can deduct those, but the government has a standard deduction that that's kind of a freebie that they give you. And if you don't have enough deductions to get over that freebie amount, then they basically just say, well, you can just claim the standard deduction and get that as a freebie. The standard deduction amount these days, if I was smart, I would have looked up the number before actually getting in front of you all and being recorded. But it's, in the $12,000 to $13,000 range. It changes every year. So it's one of those things that I've long since forgotten and don't try to remember every year because it always changes. But where the recent rule change comes in is that amount doubled at the time of the 2017 tax cuts. So it used to be about half as much as it is now, and the fact that it went up so much has really changed a lot of people's tax planning and things like that. So you should be, it's been around for a couple of years, so hopefully you've been filing your returns already knowing about that, or whoever is filing your returns for you. But that could be some tax planning strategy, or change your planning strategy, whether you're a business owner or not. And it's just something I like to point out. I think that, so I've got a couple more things, but I think that will get us to a good stopping point where we can go to questions.
Thanks, Mark. That is fantastic. And thanks to Jeremy, so much good information in there. And we wanted to also apologize that our slide at the very beginning was from our last Lunch and Learn. So you are not our mental health professionals. You are.
Yeah, I was going to say, thank God. I thought I was going to have to start talking about mental health, and
no, I don't think I could have handled that either. So there you go. This is the correct information that you're looking for. Okay, so we do have just about 10 minutes left. I'm sure there's probably questions, and I don't know if any of them you'd be comfortable asking in front of the group here today, but please, like I said, you can use the little reactions button at the bottom of the screen. If you click that, there's that little raise your hand option. I'll see your name and call you, or you can type a question in the chat. So I'll give you all a second to do that if you had anything.
I'm going to put just in case anybody has a question they'd prefer to email, I'll put my email address in the chat box as well.
That's perfect. Thank you. And Jeremy, if you're willing to do that too, that would be great.
I just realized not only do I have my ACM shirt, but I'm drinking out of an ACM mug too. So at some point I'll get used to, and the thing is, we did a remarketing. You can kind of see the, the change in our logo. So this one's really old school.
I understand that. I just started my new position with the town of Erie a couple months ago, but I had worked for 8 years with Boulder County, and I have Boulder County swag all day, every day, all over. So at least we're still in Boulder County, right?
There you go.
No questions, nothing? Any curiosities? Any just talking about anything here today?
Do you happen to know why the standard deduction went from 6 and change to 12 and change thousand?
Well, now we're getting into tax theory. Yeah, I'm going to need another 20 minutes. No, yeah, I guess I'd say there were a couple of reasons. One is, frankly, not to get political, but clearly the tax changes were unapologetically very good for high income people, and there was no attempt to be like, no, that's not no, it really was, like, especially business owners, because you get that QBI deduction, the 20% that I was talking about, and so that was a way to also help some folks that are a little lower income, where you didn't need to own a business or have some a lot of capital gain income or something like that in order to benefit from it. So that's answer number one. Answer number two is that it also made up for, they took away a deduction. There used to be both the standard and itemized deductions, whichever one you picked, but you also got a deduction for yourself and your spouse if you're filing jointly, and each of your children. And that's called that was called an exemption, and that went away as part of that. So I think that was intended to make up for some of the deductions that were being lost out of that. So it was just, moving numbers around. It sounded good, oh, we just doubled your deduction. Don't you love us? That was probably the real reason.
Thanks for that. Getting into the theory and the politics. You're treading on some scary waters there.
It's interesting being in, I'm sure Jeremy, you would agree, but in my career, being a CPA and being a tax person, particularly in Boulder, because yeah, obviously a lot of people are very opinionated politically. But yeah, when it comes to especially business owners and seeing, some of the way things really work, the sausage making that goes on behind how much we have to pay in taxes, it's interesting to see people's reactions.
I imagine.
All right. Other things you're curious about? I think you all just covered it so clearly. Clear,
Just
crystal clear.
that fascinating of a topic. They're just.
Hey, we didn't lose a single listener, so you were very fascinating. I love it. All right. Well, I just want to say thank you so much for coming here today. It's so great that we get to be able to hold some of this professional development, even in these weird pandemic times. Also, we are planning some in-person events. It's going to be very exciting. The chamber does have a golf tournament coming up. We're still working on plans for the disc golf tournament. We're going to try to figure it out. At least we can be outside and have some events. So look out for those. Again, thank you to our sponsors again, presenting sponsor, Boulder Medical Center. Thanks for talking a little bit about what you do. We're excited you're here, Summer, so we'll make some good connections. Gold sponsor, Blue Federal Credit Union, and silver sponsor, Flatiron Bank. So yeah, check out boulderyoungprofessionals.com or theboulderchamber.com. Check out all the cool events we're doing. In-person's coming very soon. So thank you so much. Everybody have a great day.
Thank you.
Thank you. Thanks, everybody.
Bye.